Hi, everybody. This is Terry Campbell with Johnson Insurance, and I'm here with another episode of Outside the Box. Today, I've got a special guest with me. I've known him for many years, and Brett Copper's been around a long time. He grew up in the business. I mean, Brett's 32 now, and he's been around the business. I tell people, I've been in the business myself a little over, going on 32 years, and so we've almost been in the business the same amount of time, except in a little different fashion. He grew up around it. He's been involved in many different ways. Brett has bought and sold self-storage facilities. In fact, he just bought another one in the last few weeks. And normally when I do these podcasts, I talk about subjects that I see from the insurance world that pertains somehow to insurance, and that I feel like people need to know or to understand or need some clarification on. But today, we're going to talk a little bit about, how there's so many people wanting to get in the business. They know people who are in the business, they've read about it, they've heard about it, they're interested in it, but they don't really know how to go about it. So I've got Brett on here today because he's done it, and he just did it again recently, and we kind of want to talk about that process, how you go about finding a facility, underwriting a facility, operating a facility, financing a facility, I'm going to talk about insuring a facility, of course. But we're going to kind of approach it from that way in a very conversational way, and we'll touch on several parts of this. And Brett, I'll let you sort of take over. Let's start. Give you any kind of background you want to do on yourself that I haven't already mentioned, and your history, and then we can sort of jump into this.
Sure. Yeah. Well, thanks for having me. At this point, you're kind of like an uncle. That I've known you, and you play that role probably more so than anything else. So, no, I think you summed it up well. I've been doing this in some way, shape, or form, even if I was mostly absorbing the information when I was a kid. I traveled around a lot with Dad doing feasibility studies, due diligence audits, and spent a lot of summers going on those trips. So, yeah, and then probably around 15, 16, I started to realize how much money was in storage, and I said, well, maybe there's something here. And then you realize that you're good at it because you've been a sponge soaking it up, and then it kind of all worked out where now I don't think I could do anything else. I love being in the business.
Awesome. Well, Brett is he's a president of Copper Storage Management. Again, he owns facilities. Just bought another one. We were in business together for a while. I worked with the guys, great bunch of guys over at Copper Storage Management for a bit before I felt like I needed to retire. But then I realized I couldn't stand it. So I'm still back in the industry doing different things. But Brett, let's talk about. Like I said, you just bought another facility. Let's talk about acquiring the facility and how to understand it and how to underwrite it and what you're looking for when you're looking for a facility. Most people are looking for a value-add facility these days. So talk a little bit about that.
Yeah, first and foremost, it's about volume. People ask all the time, how do you find a site? I think collectively we've bought 60 or so since 2019, kind of as a family group, and it's all about how many deals we can look at. I mean, that's first and foremost. We probably, for me to buy the site in Fitzgerald, Georgia, probably underwrote 50, 60 sites before I found one where I was like, oh, this works, and we can kind of get into why some of these deals work and not. But it really took underwriting that many to even find one that made sense to make an offer on. And this time we got very fortunate. They accepted the offer and we were able to go through the process. But when we're looking at these deals, there's only so many ways to add money in storage. The main things you're looking at when you look at a deal are, can we raise rates? What is the current rates versus street rates and market rates? Do we have room to improve revenue that way? Are there any ancillary revenue, items already at the facility? That could be things like tenant insurance, or even side businesses like U-Haul or packaging, whatever it might be. So just looking at some ancillary. Looking at operational issues. Are they not doing auctions? Do they have a lot of past dues? Because that's easy to fix, to get people out and put new people in. And then I think the last one is occupancy, and that could be either through adding new units and expansion, or if the facility is not stabilized. And so then you got to figure out, can we get it stabilized? How long is it going to take? And those are usually the most important. If you're going with a remote model, well, then you also have the added benefit of, can we cut payroll to help the NOI? But I think all of those factors play a big role, and it's really more about how many of those boxes can you check adds the most value to the facility. One or two boxes could be enough to make it profitable, but man, if you start checking 3, 4, 5 of those, then you could find a pretty good value add.
Awesome. And you had a very good point at the very beginning of what you were saying, that people, I don't think they realize it until they start looking, is that you've got to look at a ton of deals. I mean, you got to look at a ton before you find one that really works for various reasons. And everybody has their own buy box.
Mhm.
And no matter what your buy box is, you're going to be looking at a lot of facilities. So it's sometimes it takes a while to get that first one. And that's one of the things that I tell people a lot is, you're not going to go looking today, find one tomorrow. And I have people come to me with great aspirations of, I'm going to buy 10 facilities this year. I said, really? So are you going to look at 10,000 this year? Because you're going to be looking at a lot. It's really unrealistic, and I like to try to help set realistic expectations. So good info there. Financing, there's conventional financing, the normal bank route. There's owner financing. There's SBA finance. There are all sorts of creative ways out there. And, SBA is a world that I lived in there for several years, and I know it's a great option. And I think you just went through that process as well. Talk about what you see from financing aspects.
Yeah, in some good context, our oldest company, Self Storage 101, been around close to maybe 30 years now. Dad started that maybe 25 years. And they do the majority of feasibility studies, due diligence audits, in the country for a lot of different operators. And so on the feasibility study side, we deal with all sorts of financing and try, especially on full studies, to build out what those models look like. So we've worked alongside SBA forever. That's how our relationship started. Obviously, Terry, is you being at Live Oak, starting their storage division, and Self Storage 101 does so many feasibility studies for them. What's interesting is this is the first time any of us have ever gotten an SBA loan, even though we've been working around it for so long. And that was really born through, I don't necessarily, I don't have the money Dad does. And so for me to get deals done and be able to buy more of them, I need less equity up front. And so it was an interesting process. I mean, compared to conventional, which is obviously conventional is always going to be most popular across the board. But in an environment like this, where you might only be able to get 70% loan to value conventional, or 75%, when you can go to the SBA and get 10 or 15%, makes a big difference. Obviously, it takes longer through that process. You know that better than anybody else compared to conventional. I've gotten conventional loans where I signed one page that was, a couple paragraphs, and that's all they needed from me. And then they, send the closing docs over, especially the smaller banks. With SBA, has so many regulations and strict guidelines and approval processes. And I'll say it was easier than I thought. You're always going to have issues in, last minute items or whatever it might be. But I was impressed. I had always thought it was more of a daunting process, I think, in my head than what we went through. And maybe that's because I worked with Live Oak and they've done this for so long. But I would assume it's probably similar to some of the other big SBA banks like Bank 59. It was more easy than I thought. I was very happy with it.
Yeah, and you're right. The SBA process is definitely different, and there is much more required documentation and things of that nature. But it is a great tool for people who don't have enough equity to at least get started in the business. A lot of folks have made their start using that program, and a lot of it does depend upon the bank that you're dealing with, if the bank really understands the SBA programs, if they're preferred lenders so they can do their own approval process, and if they're familiar with the asset class. Those things right there are what make it a lot easier. And it can be daunting depending on who you're working with, but it definitely is a great tool for people to get started in. I mean, that's not my world anymore, but we helped so many people get in the business, and they're very successful now. And I'm proud to have been a part of that and helping people do that.
Under your watch, Terry, at Live Oak, what would you guys hit, $1 billion in storage lending?
When I left after 7 years, as I was leaving, we were crossing the $1 billion threshold.
Unreal.
In 7 years, and it was just a tad over 7 years. And that, I mean, there's a lot to be said there. I mean, the team that we had, the efforts we made to get out and spread the word about it. The first 2 years I was there, I felt like the SBA evangelist in the self-storage world, because people still weren't really familiar with it, and things they had heard were nightmares because people had tried to work with banks that didn't understand the SBA. They didn't understand self-storage, and by us bringing these things together and specializing in it, it's one of the great things about what Chip Mahan did when he started Live Oak Bank was, to verticalize it, specialize in that industry, and you can really be good at it. And that really worked for us as well. So that's a big part of it. But it is a great program, and we helped a lot of people. Mm-hmm. And we're very proud. I'm proud of that, and I know that everybody else that's still there are proud of how many people we helped get into this business. So, running it, let's talk about that for just a minute. You do plenty of podcasts on how to do remote management, and we don't need you to have to give us a full scale rundown, but, talk about different ways people do run self-storage facilities and the benefits to each kind.
Yeah, it's a good question, and obviously it's probably one of the most important for people getting into the business. We run into a lot of people want to buy facilities and they're trying to get them closed, and then they have no clue how to run it, and they get to closing and they're like, wait a minute, I kind of skipped a very important part. In this business, it's kind of opposite of the rental business for multifamily apartments, whatever, in that for those industries, the vast majority of rentable space now, are big institutions, big private equity or public companies or BlackRocks or whatever it might be. And so operationally, it's very sophisticated compared to some of the other, especially compared to storage. In our case, it's like the opposite. 15, 20% are big companies, 80% are mom and pop. So by far the most popular way to run a site is to run it yourself. And whether that's getting a manager, or maybe it's an owner operator where they're sitting in the office or they're dealing with it, or maybe it is remote and they're just telling people to call to rent a unit and they go clean it once a week. I think it's becoming more popular now to do third-party management in any way, shape, or form, whether that is remote where, when we say remote management or hybrid management, it's all the same types of management. We're still doing all the same roles. The difference is we just don't need someone in the office, 40 hours a week. And so it could look anything like a 1 day a week visit, 2 days a week, or even 20, 25 hours for a hybrid manager. And now I think with technology, new developments, there's more ways than ever, and people become very creative at how to run these sites, that I think it's a good thing that more owners have more affordable ways to get into the business and run it, because that's such a big hindrance for the lifespan of the industry. If you're a doctor in Illinois and you see a good deal in Washington and it's a small deal, you never could have bought it, especially if you can't afford to have somebody there. Now I think it's become a lot more affordable, easier access for people to buy assets and have them run efficiently.
For sure. There's a ton of them we see when we're insuring them that are being managed remotely, and it's just, things have changed, costs have changed. You can't afford a full-time man. You can't justify it, and unless the facility's pretty big. So it's a great option and a great way to be able to have that facility and grow your net worth and your portfolio. Now, from a management standpoint, for you guys at Copper Storage Management, you have, sir, I'm going to pivot just a wee bit into insurance now. So you guys have certain requirements for your customers. They've got to meet certain requirements as far as insurance. I see things across the board. I've seen some management companies that were like, we don't have any requirements for insurance, which kind of it's surprising to me. But, you guys, I know that you have certain requirements, and speak to that from your perspective a little bit. I can speak to it from the insurance side, but speak to it from your perspective, why you want to have your clients properly insured from a management standpoint.
First, I might as well say the whole reason we brought you on and we're excited about it was to make us corporate and put those processes in place. Copper family, we're not the most corporate individuals. If you've ever seen Dad or Bill wearing what they wear at trade shows and, flip-flops, and mostly Dad, Hawaiian shirts, corporate just wasn't our nature. And so once we got big enough, we realized pretty quickly, we've got to make this entire thing much more efficient. So you obviously came on, and one of those first things you did were insurance requirements. And man, did that pay off later, because when you've managed, I think we've managed a total of like 320 stores since we first started. I think we're at like 177 with everything signed now. And so you're inevitably going to have problems. I mean, you remember a case where someone put, water, whatever, something liquid in the unit, ate through the floor, they step into a box well, their foot goes through it, now they're suing. Had we not had insurance, specifications to make sure that the owner's protected across the board, we could get dragged into it, let alone the owner not have the coverage that they need. Or let's say a boots on the ground or manager messes up, an auction. They think that they're cleaning out a unit and it's junk inside there. It's one box left. They throw it away. It's somebody's war medals, or, it could be literally anything. I think it is nonsensical these days with the amount of attorneys, the amount of lawsuits, how popular that is, to not have yourself protected. And we can talk from firsthand experience that those protections have really saved giant payouts, in cases, because as well as I do, it doesn't even matter if it was your fault or theirs. What ends up happening is you get in a lawsuit for 3 or 4 years, nothing comes of it, and then you've spent all this money. Insurance is a really, really good way to go fight that for you and deal with it, because anyone can sue for anything at any time.
That's right. That's right. And like you said, even if there's not a payout, even if there's no award given by a judge or jury, you still got legal fees, and those that insurance can help cover that. And from an insurance standpoint, you just went through this. You just went through this on the last facility you bought, so we had to make sure we had all the right coverages for you to satisfy your needs, so you could lay your head down at night, so we could satisfy the bank's requirements that they had. And then property and casualty, it's going to cover replacement of things. It's going to cover you from lawsuits. It's going to cover you from wrongful sales and customer good claims and things like that. But you had something that snuck in at the last minute, flood insurance, that sometimes people don't realize. They don't know. And if it's something, there's something, everybody watching this, be sure if you're looking at a property, find out if flood insurance is going to be applicable to your situation, because it can be a thorn. It can sneak up at the last minute. The bank may be the one that brings it up because nobody else mentioned it. Maybe the broker doesn't know anything about it now, and maybe the owner didn't have a loan and didn't need it. But make sure that you check that out and see if it's applicable, because it can get very pricey. Luckily for you guys, it was an extra expense and more than you'd want to pay anyway, but it was you could handle it. Yeah. And some of them are bad. We've seen some that it's more than the actual property and casualty coverage, because the flood insurance can get expensive.
Man, yeah, I'm glad you brought it up, because we had never really run into this issue with any of the sites we're buying. And we had an after action report. In this case, I bought the site with one of my good friends, Eli, who's a partner on it. And it's his first real deal to buy that he owns and not just investing in storage. And so, my first big bold thing in the after action report was check for flood on FEMA's website, because especially with the SBA, they are very strict. It does not matter if the survey comes, if you can get a survey saying that you're not in the flood zone and actually you get the elevations. They only care what FEMA's website says. And so you want to know proactively, are we going to have to pay this? You ask the insurance company what it's going to cost. They have to come up with the replacement values of the buildings themselves. And we were very fortunate. Originally I thought it could be 18, 20 grand. I think we ended up for those 15 buildings settling on like $7,000 policy, which is, we can eat that. It's, I don't like it on the back end. Obviously it can affect a little bit of NOI, but as far as the grand scheme of things, it could have been way worse. And I think it's also interesting that I didn't know about this, but if you do end up seeing a large, if it's going to be a lot of money for flood insurance, something that your company told us about was being able to actually get a group that goes to FEMA that can get it petitioned to take you off the flood map, which means you're not going to need that insurance. So I was very blown away by that. We're kind of in the process. The only thing is now because it's only that $7,000 a year, it just might not make sense to pay to get it taken off. So we're going to have to weigh that out. But I actually have a meeting with that company you guys sent us after this one. So we'll see what they say.
Awesome. Good. Well, one last topic I want to touch on is the subject of you don't know what you don't know. That right there was one of the things. Anything else that you could bring to the surface of things that you didn't know, other than something like the flood insurance? Is there something like that you might be able to point out to folks to think about?
Yeah, I would say understanding the current management systems that are in place and ancillary revenue models. This deal was unique in that they are basically a commission-based quote unquote dealer for selling sheds all over Georgia. And so there's a company, the Mennonites make these sheds and then they leave them on site and they sell them. When we first saw that, we're like, there's no way we're going to keep that. That we just don't know that business well enough. Well, then, man, we get there and we look at the amount of money it's been making, and then we see the manager who's been in place that wanted to stay on just to keep selling sheds, and I was blown away. And we to the point where we might not even add the new units because the shed does so well and it doesn't incur costs for us. So understanding the extra business models instead of just dismissing them because for efficiency's sake, we almost always just throw them aside because we want to keep it easy and simple. Sometimes those ancillary models make sense. I think aside from that, really understanding CapEx needs is super important. A lot of people don't do enough due diligence on that side. We've obviously done it enough where we know to look for that. We're looking for what the big expenses could be. The building's in good condition. Are the roofs okay? The doors, cameras, lights. Are we going to need to add a gate? And then I'd say lastly, where a lot of people mess up are the claims over the last 5 years for the facilities. Do they have a ton of break-ins? Do they have a bunch of issues on site? Do they have people, managers stealing, or have they just been throwing away people's stuff for auction for the last 10 years, which we've seen deals where that's been the case. So do you have liability there? I think understanding those are usually the normal pitfalls. And then the last piece I would say that we know about, but a lot of people forget, are the small admin pieces like getting a business license, making sure that you have that insurance in place in time, making sure that, your taxes are done correctly. Where do you have to have sales tax? Is it parking? Is that going to be different? How is the new property taxes going to be assessed? Because each state and counties are different. And so a lot of people run into it where they think they're going to pay $20,000 a year in property taxes. Facility sells, their next bill next year is $50,000. So I think if I was giving that advice, it'd be those are usually the points people brush past and don't think about that could hurt you later on.
If you hadn't mentioned that last topic I was going to, because I've seen so many people who they just look at what property taxes are now. They don't think about how, asking the municipality or the taxing authority, how do you handle taxes? And I've seen them double and triple once someone bought it. And it just throws them completely out of positive cash flow. So all excellent points there. I want to say, I appreciate you. Number one, I appreciate you allowing us at Johnson Insurance to take care of you on your new facility. I know we provide the insurance for the whole portfolio. We also provide insurance for copper storage management and your business insurance. So we appreciate that and the trust that you guys have in us. And I appreciate you being on here and doing this podcast today.
Well, of course. Thanks for having me. And this is not a plug. This is honesty for you. But yeah, you guys have been the easiest to work with on the insurance side we've had. And I think what I like the most is that if there is an emergency, something happens, I can get you on the phone immediately, or any of your other staff. I mean, you're on vacation answering calls when you shouldn't be. So no, we appreciate you. And that is not a plug that, hey, I'm on your podcast and I have to sell you. It's just the truth. And we use you guys for a reason. We appreciate you. Everybody on your team's great.
Well, I appreciate that. Well, again, thanks for being with us, Brett. And thanks, everybody, for watching this episode of Outside the Box. Be sure and join us for the next one. Thanks, everybody. Have a great day.
Thanks, guys.